Welcome to the SafeSimpleSound podcast, where our approach to financial planning creates both and solutions for the contradictions families face. We believe that financial clarity isn't about chasing the highest number, it's about building a house that stands firm regardless of the weather. Today, we are beginning a vital conversation. This is the first episode in our Understanding Risk Measurement series, and we are exploring a concept that keeps more families awake at night than perhaps any other financial topic. We are exploring the concept of risk. Specifically, we are looking at the difference between what the math says risk is and what you feel risk is. This draws directly from our recent blog post, Beyond the Bell Curve, which you can find on our website. Let me ask you a question to start. If you look at your investment statement or log into your 401k portal and you see that the balance has dropped from the previous month, what is the physical sensation you feel? For many, it is a tightening in the chest, a pang of anxiety, maybe a sudden urge to do something to stop the bleeding. This reaction is entirely human. But drawing from our S3 financial planning approach, we have observed that this reaction is often based on a misunderstanding that the financial industry has unintentionally taught us. We have been trained to view risk and volatility as the exact same thing. If the line on the chart wiggles down, we are told we are experiencing risk. But here is the vision-first contradiction we must resolve today. Mathematical volatility is not the same as financial failure. In today's episode, we are going to dismantle the anxiety surrounding market movements. We are going to apply the safe, simple, and sound framework to help you distinguish between the noise of the market, what we call the wiggle, and the actual destruction of your plan, what we call the break. Whether you are nearing retirement and worried about preserving your nest egg, or you are in the building phase and confused by market swings, this episode will give you a tool set to view your money without the panic. Let's establish our foundation. To understand why we feel so much anxiety about our money, we have to look at how the traditional financial industry measures risk. In traditional finance, risk is almost exclusively measured by a metric called standard deviation. Now, we promise to keep this simple. We aren't going to do a statistics lecture. But it is important to understand the engine under the hood of most financial advice. Standard deviation is a statistical tool. It measures how much an asset's price bounces around its average. Imagine a bell curve, that nice symmetrical hill shape you might remember from school. The theory assumes that investment returns follow this shape. Most days are average, right in the middle of the hill. Extreme days, big jumps up or big crashes down, are out on the edges, the tails of the curve. The industry tells us that if an investment has a high standard deviation, it is risky. If it has a low standard deviation, it is safe. While this is useful for mathematicians and portfolio managers running algorithms, our SafeSimpleSound methodology suggests this is often a trap for actual families. Why? Because your life isn't lived in averages. You don't pay your mortgage with average returns. You pay it with cash. You don't fund your retirement with a bell curve. You fund it with the money that is actually in your account when you need it. When we rely solely on standard deviation to define our safety, we make a critical category error. We treat a temporary price drop in a quality asset the same way we treat a permanent drop in a bad asset. Think about that for a moment. If the stock market drops 10% because of a temporary economic scare, but you own quality companies that are still making profits, that is a temporary fluctuation. However, if you own stock in a company that goes bankrupt and drops 100%, that money is gone forever. Standard deviation treats those two movements as simply volatility. But to your family, one is an annoyance and the other is a disaster. From a safe first perspective, conflating these two things creates unnecessary anxiety. If you believe every downward wiggle on your statement is a threat to your safety, you will live in a state of permanent stress. You will be constantly looking over your shoulder, waiting for the sky to fall. At SafeSimpleSound, we draw a hard line between two concepts. This is the core distinction for today. Number one is volatility. We call this the wiggle. This is the temporary fluctuation of price in an asset that remains fundamentally sound. The stock market goes up, it goes down. It reacts to news, elections, and earnings. But if the underlying asset is solid, this movement is just noise. In fact, we argue that the wiggle is the price of admission for long-term growth. You cannot have the growth without the wiggle. Number 2 is permanent loss. We call this the break. This is the permanent destruction of capital that cannot be recovered. This is buying high and selling low in a panic. This is investing in a speculative venture that goes to zero. This is true risk. The industry, and the media, frankly, wants you to minimize volatility at all costs. They sell safety as a flat line on a chart. But often, minimizing volatility comes at the cost of your future growth. If you bury your money in the backyard to avoid the wiggle, you guarantee a different kind of loss, the loss of purchasing power due to inflation. Our practice advocates for a both-and solution. You can have a portfolio that bounces around, accepting the volatility while remaining completely secure in its long-term objective, ensuring safety. We want you to accept volatility to eliminate loss. This aligns with the principle of vision-first direction. If you know where you are going, the bumps in the road matter less. If you are driving to a vacation destination and you hit a pothole, you don't turn the car around and drive home. You acknowledge the bump, the wiggle, and you keep driving toward the destination, the vision. But how do we know if the wiggle is worth it? Drawing from our CFC background at SafeSimpleSound, we utilize a concept called the coefficient of variation. That sounds technical, so let's make it simple. Think of it as the price per pound of risk. Imagine you are in the grocery store. You can buy a small steak for $10 or a massive family pack for $15. The family pack costs more total dollars, but the price per pound is much better. You're getting more value for your money. Now, apply this to investments. Let's say you have asset A. It has a volatility of 10, it wiggles a little bit, and it returns 5% a year. Then you have asset B. It has a volatility of 20%, it wiggles twice as much, it feels scarier, but it returns 18% a year. Asset B bounces around twice as much. Is it riskier? Mathematically, yes. The standard deviation is higher, but structurally, from a SafeSimpleSound perspective, you are getting paid almost 4 times the return for only twice the bounce. Asset B is actually the more efficient vehicle for your wealth. It is the better price per pound. However, and this is the crucial caveat, it is only better if you have the vision-first discipline to endure the ride. If you panic and sell asset B when it wiggles down, you turn a temporary movement into a permanent loss. This is where the psychological safety of our framework comes in. We don't just look at the numbers, we look at the human ability to stick to the plan. To illustrate this principle of differentiating between the wiggle and the break, let me share a hypothetical scenario. While this story is created for educational purposes, it demonstrates patterns we frequently observe when families apply SafeSimpleSound thinking to their retirement planning. Consider a fictional couple. Let's call them Arthur and Martha Miller. The Millers are 62 years old, just a few years away from their targeted retirement date. They have worked hard, saved diligently, and built a nest egg of $1.5 million. In our scenario, Arthur and Martha have a vision-first goal. They want to generate enough income to travel to see their grandchildren and maintain their lifestyle without ever running out of money. Suddenly, the market enters a correction. Over the course of 3 months, the stock market drops 20%. Arthur opens their statement. Their $1.5 million is now showing as $1.2 million. On paper, $300,000 has vanished. Arthur feels that pang of anxiety we talked about. His heart races. He calls Martha into the room. "Look at this," he says. "We're losing everything. If we don't sell now and move to cash, we might not be able to retire." In this moment, Arthur is viewing the situation through the lens of traditional risk. He sees the downward line, the standard deviation, and his brain interprets it as the break. He feels that his financial house is collapsing. Now, let's pause the scenario and apply the S3 framework. If the Millers were utilizing a SafeSimpleSound strategy, how would this conversation go differently? Instead of looking at the aggregate number, they would look at the structure of their holdings. They would ask, did the companies we own go bankrupt? Did the economy cease to function? No, the prices simply repriced based on temporary news. In a SafeSimpleSound plan, the Millers would have a safe bucket of money, perhaps cash or bonds, set aside to cover their near-term expenses. They would know that their grocery money for the next 2 years is not in the stock market. It is safe. It is not wiggling. Because their immediate needs are met, they can look at the $300,000 drop in their long-term portfolio differently. They would recognize this as the wiggle. They would recall the principle of the coefficient of variation. They accepted this volatility because, historically, the market pays a premium for it. They are being paid to endure this exact moment. So instead of selling, which would turn that paper loss of $300,000 into a permanent loss of capital, they do nothing. Or perhaps they rebalance, buying more quality assets while they are on sale. While this story is fictional, it demonstrates how our framework shifts the power dynamic. Without the distinction between wiggle and break, Arthur and Martha are victims of the market. They are forced to react to protect themselves. With the distinction, they are owners of a plan. They understand that the drop is the price of admission for the recovery that follows. Through this example, you can see how thinking applies to the emotional side of money. The market didn't change. The Miller's understanding of the market changed. This connects back to our sound principle. A sound financial plan anticipates the storm. It doesn't pretend the sun will always shine. It builds a roof that can handle the rain. If Arthur and Martha had sold, they would have committed the ultimate financial sin in our framework. They would have converted a temporary fluctuation into a permanent failure. They would have taken a math problem and turned it into a life problem. Whether you are facing this exact scenario or something similar, the lesson holds true. The anxiety you feel is usually triggered by phantom risk, the fear of the noise. Let's bring this back to your kitchen table. From a SafeSimpleSound perspective, this provides the stability we look for. When you can look at a downturn and say, this is uncomfortable, but it is not a disaster, you have achieved a level of financial maturity that few attain. We often say in our practice that we want to accept volatility to eliminate loss. Think about that trade-off. If you refuse to accept volatility, if you keep all your money in a savings account earning 1 cent, you feel safe in the short term because the line never wiggles down. But you are guaranteeing a long-term loss against inflation. The cost of bread and gas goes up, but your money stays flat. That is a slow break. It's a permanent loss of purchasing power. By accepting the volatility, by letting the portfolio wiggle, you give your money the chance to outpace inflation. You endure the temporary discomfort to ensure the permanent safety of your lifestyle. This is the essence of sound decision-making. It is logical, it is historical, and it is rooted in how markets actually work, not how we wish they worked. As we wrap up this first installment of our Risk Architecture series, let's summarize the key insights we've covered today. First, we recognize that mathematical volatility is not the same as financial failure. The industry uses standard deviation to measure the wiggle, but you should be focused on avoiding the break. Second, we explored the concept of the coefficient of variation. Just because an asset bounces around more does not mean it is worse. If it provides a higher return per unit of risk, and if you have the time horizon to endure it, it may be the more efficient choice for your family. And third, through the hypothetical story of the Millers, we saw that true safety comes from clarity. It comes from knowing which bucket of money is for today safe and which bucket is for tomorrow growth. When you separate those timelines, you stop panic selling your future to pay for your present. So what is the practical next step for you? We encourage you to perform a risk audit on your own thinking. The next time you see a headline about the market dropping or you see red on your statement, pause. Take a deep breath. Ask yourself, is this a wiggle or is this a break? Is the fundamental structure of your plan damaged or is the market just being the market? To help you see this clearly, our team has developed a foundational tool derived from our S3 practice. We call it the Volatility Decoder. This is a guide that includes our wiggle versus break visualizer and a fake risk detector checklist. It is designed to help you audit your current holdings and stop panic selling during normal market movements. This episode draws from our recent blog post Beyond the Bell Curve, which you can find at SafeSimpleSound.com. You can download the Volatility Decoder right there in the post for the complete written framework. Through our S3 approach development, we've created this resource because we believe educational generosity is a core value. Whether you ever become a client of SafeSimpleSound or not, we want you to have the capability to distinguish between noise and signal. If today's S3 insights resonate with your family's situation, if you find yourself wanting a guide to help you distinguish the wiggle from the break, we invite you to explore what financial planning could look like through our Safe, Simple Sound practice. But either way, you are now equipped with a capability, the ability to look at risk not as a monster to be feared, but as a tool to be managed. Thank you for listening to the Safe, Simple Sound podcast. Remember, a plan that is safe, simple, and sound is the only plan that truly lets you sleep at night. We will see you in part 2 of this series. Until then, keep your vision clear and your foundation strong.